Hello world, welcome back to my channel. If you're new here, my name is Tommy and every week I make videos about personal finance, investment strategies, and everything in between. If such topics interest you, subscribe to join our community of like-minded individuals. Today we're going to be discussing free cash flow. What is free cash flow? Why should investors like you and I care? And how do we go about calculating it for individual stocks? Let's get started, shall we? Welcome to Free Cash Flow Explained. I'll start off with defining what free cash flow is and how it can help investors like you and I. We'll then apply the price to free cash flow ratio to several stocks and compare it with other valuation metrics. Finally, I'll share some key takeaways. First, some caveats about free cash flow. It is actually not part of generally accepted accounting principles, according to the SEC. Therefore, it is not legally required for companies to report this number. Also, free cash flow is not the only metric we can use to estimate value. According to Investopedia, free cash flow represents the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. What does that mean? It means this is the cash the company has left over to do whatever it wants. It accounts for all the costs of business. Free cash flow is needed to calculate the price to free cash flow ratio, which is a valuation metric. To derive the free cash flow, we need either cash from operations, earnings before interest and taxes, or net income. Since cash from operations are readily available in annual reports, we can simply use that. We just take the free cash flow from operations and subtract capital expenditure. If you want to calculate this at a per share level, you simply take the total free cash flow for the year and divide it by the number of shares outstanding. Let's practice calculating free cash flow. Suppose you own the venture company, which is in the business of mining and drilling, extracting resources and selling them in the wholesale market. First, we need to calculate what the cost of business is. This includes things like the cost of goods sold, the operating expense, the overhead expense, and capital expenditure. Suppose this company brings in $1,000 worth of sales every year. We then calculate the cash flow from operations, which is the sales minus the cost of business. We then take the cash flow from operations, CFO, and subtract capital expenditure, things like the cost of investing in a new factory or equipment. Now, suppose you want to buy this company. How much should you be paying for this? Well, it depends on your expectations. Let's say your desired yield on this company is 20%. This means that you should be paying the inverse of 20%, which is 5 for the price to free cash flow ratio. We then take this ratio and multiply it with the actual free cash flow, which means you should be paying no more than $3,000 for this company, assuming that you do not expect it to grow. Now, how does free cash flow help investors? There are three things. Let's start with valuation. So free cash flow gives a realistic valuation for a company because it accounts for capital expenditure. For large companies, capital expenditure can be significant. Next, the quality of earnings. First, suppose both earnings and free cash flow is increasing over time. This means that the business is growing. And as investors, our natural question should be, how sustainable are the current growth drivers? Second, if earnings are decreasing but the free cash flow is increasing, this also means that the business is growing. However, we should look out for adjustments that cause the earnings to decrease. This can be anything from depreciation, stock-based compensation, or some kind of deferred income tax. Thirdly, if earnings is increasing but the free cash flow is decreasing, it's a sign that the company is probably unsustainable, unless we can justify some kind of long-term value from the capital expenditure that they are spending on. Next, we can look at the trends for price to free cash flow. If this multiple is consistently increasing, this shows that the market is generally bullish about the company. If the price to free cash flow is decreasing, this might be because there are threats coming from various competitors, or that there are bad news surrounding the company, such as scandals and fines. Note that valuation only tells half the story though. Assumptions about growth are equally important. In fact, the discounted free cash flow model relies on both numbers and assumptions. Now, let's try to calculate the price to free cash flows for several companies. I'll start off with Alphabet Inc. First, we need to find the operating cash flow for Alphabet. This can be found under the consolidated statements of cash flows in annual reports. Under operating activities for 2021, Alphabet made $91 billion. Next, we need to calculate the capital expenditure. For Alphabet, the capital expenditure is mainly for technical infrastructure, which consists of their investments in servers and network equipment for computing, storage, and networking requirements. The second capital expenditure is office facilities, ground-up development projects, and related building improvements. So the total capital expenditure was $24.6 billion. Now we can calculate the price to free cash flow for Alphabet. Assuming that the market values them at $1.8 trillion, we take the cash from operations and subtract the capital expenditure. And this gives us 27 for the price to free cash flow. What this means is that if you bought the whole of Alphabet, you can expect to yield 3.7% from the free cash flow. Next, let's do the same for Netflix. So Netflix has a negative free cash flow for most years. So I'm just going to take their 2020 numbers where they had positive free cash flow of $1.9 billion. Next, let's look at the capital expenditure for Netflix. So they need to spend money acquiring land, buildings, furniture, information technology, corporate aircraft, machinery and equipment, and so on. So in 2020, this cost them almost $1 billion. To calculate the price to free cash flow, we simply take their market cap in 2020 and divide it by the free cash flow that was provided in their annual report. And this gives us a 122 times multiple. This is really high and goes to show how much the market is expecting Netflix to actually grow. Next, let's look at Palantir Technologies. So the operating cash flow for their most recent annual report is $238 million. Next, let's look at the purchase of property and equipment amounted to $12.6 million. However, if we were to consider all of these items as capital expenditure, computer equipment, furniture, and construction, it will be a higher number, 31 million. So I'm going to use that in my calculation. So for Palantir, the free cash flow is $207 million and they're trading at 123 times multiple, which is even higher than Netflix. This shows how much expectation is built in even at their current prices, which is significantly lower than their all-time highs. Next, let's talk about valuation methods. No valuation is perfect, but depending on the type of company, some are more suitable than others. First, the price to earnings ratio. This is the most common and easiest to filter for in various tools you can find online. It is applicable to profitable companies. However, it is not reflective of the true cost of business. As for price to sales ratio, this metric is useful to compare non-profitable companies.
I just thought that mainly the goal of companies is to make money.
Yeah, no, that's not how it works.
And how I would use it is to compare it with revenue growth. If a company has high revenue growth, yet the market is valuing it at a low price to sales ratio, I would consider it a cheap growth. Whereas if a company has low revenue growth and a high price to sales multiple, I would say that this company is relatively expensive. Last but not least, the price to book ratio reflects the price compared to the liquidation value of a company. It varies widely based on industry and seems to be more useful for asset-heavy companies such as Disney and JP Morgan. So here are some key takeaways from my research in free cash flow. First, it accounts for the true earnings and the cost of business, making it one of the most valuable metrics you can look at. Secondly, free cash flow is not always provided in annual reports or other platforms. Regardless, you should calculate it. Thirdly, free cash flow is most useful when used as a valuation metric, such as price to free cash flow or enterprise value to free cash flow. We hope you have enjoyed our breakdown of free cash flow. If you are interested to hear more from us, subscribe to our channel to get notified every time we release new videos. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you found this helpful, share this with your friends and family. We'll see you in the next video.